I do, again, want to thank each and every one of you for being here. Thanks to the staff at Olympic for putting it on. Thanks to all of our speakers. You're going to get a warm welcome from Joe. And so with that, I'm going to turn it over to our Chief Banking Officer, Arlene Sullivan. And Arlene is going to share with you the poll results that you all took in advance. And thank you for being here.
Thank you, Dan, and welcome everybody. As Dan mentioned, we're going to review the poll results. So you each filled out a survey. And like Dan said, this event is really about sharing market intelligence. That's why the event is called Market Intelligence, MIT. And so it's really fun to look back at what we thought about last year and what we're thinking about this year and the coming year. So let's start. So each year we ask the same 17 questions, and they cover areas ranging from sales, what our sales expectations are, what we actually did and what we anticipate, rates, the economy, real estate, staffing, compensation, all the big stuff. So we're going to go through each of the questions and see how we looked at it last year, what we're thinking about this year. So for actual sales, 2024 was a little better than 2023. Overall comparable and pretty solid in both years. If you add the up categories, we had 83% of us experienced increase or flat sales as compared to last year of 69%. So really good revenue in both years.
Yes. Yeah, I was just going to jump in real quick. Arlene, before you jump to the next slide, if you're having trouble seeing, there's a QR code on the table as well that you can scan with your phone, and it'll give you the poll results that you can follow along. So carry on, Arlene.
Is this a better view for the slide? Is that better? Okay. All right. So for looking ahead to 2025, it's really promising. So what we think is if you add the up categories, including flat, we're looking at a 96% increase in sales next year, as compared to only 4% down. So very optimistic. Last year, it was about 92% in the flat to up categories. So we're feeling pretty similarly about anticipated sales for the coming year. And if you look at our actual sales growth in 2024 that we projected, it was very comparable to what we anticipated it would be. So this group was very accurate in their projection last year. And so hopefully that's true again this year, because we're really looking to have a good year in 2025 for sales. We're going to move from sales to staffing. So talking about staffing both in levels, compensation, and where we work. This is all very, very relevant. So actual staffing was very comparable year over year. Mostly, we've responded that we've either added staff or stayed flat, and that we expect to do the same next year. And this makes sense given that we've had good sales and expect to have good sales in the coming year in 2025. So up or flat in 2024, almost 80% of us either stayed flat or added. 19% went down in FTE, compared to 84% up last year and 13% down in staffing. So generally very positive on the employment front. This is very, very, very relevant topic, on-site, off-site, hybrid. What was really interesting as we reviewed this information is that if you look at the 100% in office, it's really a topic that is quite in the headlines. You hear about a lot of companies calling people back to the office 100%. In our group, what we're showing is that 20% drop in 100% in office, which is interesting. So last year, to have 68% that were 100% in office compared to 49% this year. So that was probably the biggest change that was a little different than what we might read in more national headlines. Like Dan was saying, what's really cool about this is that this is our community, it's our network. it's the intelligence and the market information that we're sharing among us. So this may be a little different than what we read in the national headlines. TCB, as an interesting point, is 100% in office, of course with flexibility for people's needs, which works really well. As we look ahead to 2025, what's the staffing that we expect to do next year? It's very promising. So 96% is in the up category, so flat to up, as opposed to 100% last year. So what this really makes sense given our strong expectation about sales growth. We don't need to reduce staff. We need to probably at least keep the staff that we have or add to help with our sales growth. Wage growth. So we hear a lot about inflation and how are our wages that we're offering keeping up with that inflation. 0 to 5% category, if you add that up, that's the bulk of our responders are in that category. So in 2024, 70% of us expect to have wage increases between 0 and 5%. 30% expect more than 5%. That was very comparable to last year as well, and probably in line. It probably feels a little light compared to what inflation feels like, but that makes sense. Capital spending, infrastructure, office, et cetera, equipment. I was just talking to one of our attendees who owns an equipment company, and they're doing great. They're above 5% in sales growth. So equipment, there is investment in equipment and infrastructure. What we see in our survey responders is that it's about evenly split. So if you add up the categories of none to minimal, that probably is the lion's share. It's 57%, but it's kind of evenly split, and there's certainly some strong investment, moderate to significant. So about 50-50 if you want to round it. We're going to go into the economy now, and what we know is that as we are closer to information, as we have more control over things, we have more confidence typically. So what's typical in seeing this information as we talk about the Twin Cities economy, and then the U.S. economy, and then the global economy, you'll see an erosion in confidence along those different categories. I think it's pretty typical given that we all have more confidence in what we have more control over. So as we look at the Twin Cities economy, if you add the average to strong to very strong categories, 85% of us think that it's a positive trend. So adding those categories. It was the same last year. Now, if you dissect the categories, there's actually a little more optimism in the strong category. So definitely 85% of us last year and this year think the economy is on the upward trend, which is great. There's a little more optimism this year than last year because the strong category is more prominent. Again, as we look at the U.S. economy, you're going to see that confidence levels go down just a little bit and go even further down as we look at the next slide on global. So 77% of us think that the U.S. economy is average to strong. The global economy, we have very little confidence in. So you can see that we feel like the global, 66% of us feel like the global economy is very weak. Again, not atypical for that differentiation between local to global. This is a question that we ask ourselves when we're doing strategic planning or in our leadership discussions, and it's a question all of us as bankers like to ask our clients. What's your biggest challenge? What keeps you up at night? The categories that we have here, we decided IT and cyber risk, supply chain concerns, which were a big topic during the pandemic, labor force, market conditions such as recession, interest rates, et cetera, and then political environment. And so what's interesting about this is that there's really similar results with the emphasis being on market conditions. So from year to year, you can see that our biggest concerns are about the market and market conditions. The only difference there is that some of the market concerns have fallen into the political concerns. And like Dan said, it's an election year, so that's very understandable. It creates uncertainty until those election results are in and we have a stable environment. Rates. What a rate ride and roller coaster we've been on in the past couple of years. And certainly we're on the downhill, which is what we all feel and what these results show. So in the next 12 months, you can see that 73%, if you add up the flat to up, we all think rates flat to down, we all think rates are going down. That is exactly in line, of course, with what the market and the Fed are also saying. And then as we look at the 3-year survey results, similarly, although a little less pronounced in the down cycle. So we're going to move on to real estate. And so real estate's important to all of us, to our clients, to us personally, and to our economy. So we're going over both residential and commercial. So in the residential world, we asked everybody about how do you think residential housing is doing? Single family rental, leaving Minnesota, leaving downtown, owning versus renting, moving farther out, larger homes. And so what the consensus really shows is that we do think people are leaving downtown, that they are moving further out, and that they're scaling to smaller homes. I think all of us would intuitively see those trends. We do see an increase in expectation of people looking to own versus rent, which also makes sense given the downward rate cycle and the affordability that will provide, which is exciting. As we think about commercial real estate and our sense about whether it's up or down, last year we were a little bit more gloomy about commercial real estate. So in the down category, if you add flat to down, 71% of us were concerned about commercial real estate last year, as opposed to 47% of us this year. And the thing about commercial real estate, and we talk about this in our banking world, it's really not fair to paint with a broad brush. There are different categories of commercial real estate, and that's what we get to next. What are the categories of commercial real estate that we're most concerned about or optimistic about? In the concern category, you can see in both years, the office property type is most concerning, and it has to do with the trends that we talked about in our workspaces, people moving to hybrid, out of office, et cetera, remote. And as we look at what we're optimistic about, it's sort of the flip side of the concern category. So we're not optimistic about office, right? We are excited about multifamily and industrial. So those are things that we experience at the bank that you're probably experiencing in your businesses or see in the economy. So that wraps up our poll results. And now I'm going to turn it over. I thank you very much. And I turn it over to Joe, who's going to moderate our panel.
Well, very excited about the panel we have here today. And thank you, everyone, for joining us. I'm Joe Bauer. I'm the president of Tradition Capital Bank. The purpose here with our panel is to hear directly from people who are owning and operating businesses, kind of what they're seeing out there. So before we get going, I know we have the bios out on the table for everyone to look at, but I'd just like for the panelists to get a chance to just tell us a little bit about who you are, what your role is, and what your business is. So we do have a mic right there, Pete, that we can pass. I'll pass this one as well, but for the ones further down, then we can do that. So Kelly, why don't you start?
Thank you. I don't love being first, but that's all right. So I'm Kelly Wade. I am a founder of Berlect. We launched 3 years ago. I've got 2 partners in my business, and we provide consulting services as well as staffing services in accounting, finance, and HR. And lately, our world is being stretched to a lot of different areas and really just solving complex problems. So, and before that, I started my career as an accountant, and it was a little misplaced in that, but it was a good foundation foundation for me. So that's a little bit about me, and passionate about really connecting people and helping them on their career journeys.
Hi, I'm Greg Treble. I'm the Director of Investments and Financial Planning for Traditional Wealth Management. And I joined the firm about 7 years ago, so I've been there a little while now, seen it grow quite a bit. My role is really to do a lot of the investment research and sort of do a lot of the market research and determine kind of what are the areas of the market that we think are attractive versus unattractive, and kind of structure our model portfolios along those lines. So that's kind of me.
I'm Pete Dienovic, started Buell Investors. We are a multi-strategy, closed-end real estate fund. We're on our fourth fund today. We have about a $500 million of assets under management. Prior to starting Buell, I was with Carval Investors doing alternative investment alongside Greg Treble. So all in real estate and across a variety of product types.
Hi, Matt Lockhart. I am with Revenue Rocket Consulting. We're M&A advisors in the technology space. My entire career has been in technology. Prior to this, I was a partner at a software development and consulting firm. A couple of connections here. I'm actually, the guy on the end here, Chad, former line mates with Chad in high school. And I'll tell you, I fed him a lot of goals in high school. And interestingly enough, my wife works with one of your partners, Christy Lockhart, at Berlect. And so it's been fun to learn about the stories about your growing organization. So great to be here, great community.
Paul Grabo with Robert Thomas Homes and RT Urban Homes. I president, manage day in and day out operations. Also have a role in RT Residential, our merchant building company. I've been in home building my entire career from the time I was 20 years old, and just once this industry grabs you, it just holds on and doesn't let you go. So excited to be here today.
Hi, Chad Schumacher. Thanks for the call out, Matt. I did score once. And I thought it was funny, MIT. Greg could have went to MIT. I could not have. So tough questions go that way. So I'm the managing director of Traditional Wealth Management. We manage about $2 billion in assets for clients' 401k plans. We have an insurance company. I have 4 partners. We have 26 people now that help take care of all of our clients. Been doing this for about 31 years, and I really look forward to getting some good questions today.
All right, we're gonna dive right in then. We're gonna get right into the meaty stuff, like interest rates. So we'll start there. Obviously, being a banker, that was a big impact on our business. And in September, we finally started to see a bit of our first rate reduction. And now they're talking about a couple more rate reductions here later in the year, and then the economic news changes a little bit every day, so we're not totally certain what it's going to look like. But maybe I'll start with Greg and Chad to kind of toss it to you. With the talk of interest rate declines, what are you kind of seeing concerning your clients? Is that an impact for you guys? I can pass it to you here, Greg. How is that impacting what your clients are seeing?
Yeah, so I guess there's 2 ways to look at it. One, the impact is, on one end, it's favorable. Obviously, when the Fed reduces rates, it reduces interest rates on revolving credit, and credit cards, that type of thing should benefit from that. Our clients don't typically have a lot of credit card debt, but their businesses do tend to obviously utilize the banks for revolving credit, and so I think from that aspect, it's a positive. On the flip side, from the investment standpoint, we've been in this kind of unique period, not unique necessarily, but typically, if you talk about the yield curve, which I spent a lot of time talking about with our guys and looking at yields, typically it's just it's just a graph of mature or yields from the 3-month T-bill all the way up to the 30-year Treasury bond, and that slope is supposed to be, or that yield curve is supposed to be upward sloping. And for the last year plus, it's been inverted, meaning 3-month, 6-month Treasury bills have been yielding 5.5%, while the 10-year Treasury bond is yielding 4% or less. And that is unique because it happens really at the end of the business cycle. Normally it happens before when the Fed has hiked rates and recession is nearing, and the market's seeing the path of rates going lower. And what's unique this time is it's held kind of in that range for such a long time, a bunch longer than normal. But regardless, the 5.5% on risk-free short-term money, completely liquid. When the market gives you that, you take it. And so that's one thing that I would say over the last year or two. The amount of it had been a long time since we bought Treasury bonds or Treasury bills for our clients because there was no yield there, and that's been great for people. 5.5% is real money, and that's been attractive. That's going away. I mean, it's not going to go away overnight, but each time they cut and then get closer to another cut, those Treasury bill rates are going lower. So it doesn't mean necessarily that all interest rates are going lower. Since the Fed cut the Fed funds rate by 50 basis points, the 10-year yield is up quite substantially since then. So when people say interest rates, there's the short end of the spectrum, and then there's the longer end of the spectrum. The short end is controlled and completely influenced by the Fed. The longer end is not. And so our clients are going to have to look outside of that very short duration kind of spot to find yield going forward. So.
Yeah, if I could just add, I'd say I think the market thinks that Jerome Powell has done a great job with the soft landing, as we're sitting at all-time new market highs when we left here today. We got to be a little cautious because it's kind of counterintuitive. They're going to lower rates if the economy is going to soften. Like, how far do we want them to go down? So, this is kind of a balancing act that we have. Private equity deals will start getting done as rates continue to lower. There'll be a lot of real estate projects that we're maybe trying to gear up that now we'll probably go there. And then a lot of the technology companies borrow a substantial amount of money to grow. And as interest rates come down, it helps them as well.
All right, thank you. So I'll summarize what I heard, which was you can't get yield on treasuries, so you should probably move your money to Tradition Capital Bank. And it's a great time to take a loan out as well, right? That's what I heard there. Okay, thanks, guys. Good start. All right, Pete, maybe I'll turn it over to you as someone in commercial real estate. Maybe just your perspective on how the high rates impacted your business, and then if it's a declining rate environment, kind of what you see there.
I think for our firm, the impact today is muted. We don't have any floating rate debt across our portfolio of assets. However, I think if you look at the marketplace today, it's been really a challenging environment. And so when you talk about 5.5% treasuries, our expectation is that on any given deal, we're going to get a positive spread over whatever that risk-free rate or whatever that underlying loan is, and the interest rate accruing to that piece of paper. I think today's marketplace in the commercial space is betting that one of two or maybe both things happen, and I think that is a fascinating bet. One, they're betting that rates drop, right? And so if you look at the trading around the longer dated treasuries, you would look and say, all right, over the next, between now and December of 2025, we're betting that we know that there are 10 meetings, Fed meetings, and we're betting that there's going to be 5 to 6 rate cuts. That's a bet. You might believe it, you may not. I happen to look at the overall environment with defense export and some of the Inflation Reduction Act projects that are just getting started as actually being inflationary and therefore potentially putting pressure on those assumptions. The second bet that people are making is that, well, naturally we've had a pause for the last 12 to 18 months. And so therefore we can expect logically to see a pretty material move on top line revenue, right? Lack of supply being delivered to the market, and therefore, we're going to have some tailwind. I think that works in specific instances. I think that can work in industrial. I think that can work in a medium-term view on some multifamily. I think where that gets pressure is on all the underlying expense assumptions, which are not entirely decoupled from what we're talking about here. And so we've clearly gone through a period of time that is challenged. I think what is going to be really exciting about 25 is actually the opportunity to track some of the larger institutional investors exiting, either because they have the end of a closed-end fund, then it's really just about repatriating money, or rebalancing portfolios, which is going to kind of reset the capital stack. And that's clearly what needs to happen if you don't believe that rates are going to kind of go back to the old paradigm.
Thanks, Pete. Paul, we'll go to you. What about on the residential side? How's business been in a higher rate environment? What's the outlook if rates are coming down? What do you see there?
So the high rate environment was really tough. Last winter, kind of right after Christmas, we saw rates go down a little bit, and we really pay attention to the amount of registrations we're seeing through each of our model homes. And it spiked as soon as rates lowered down a little bit, and that was just the best leading indicator of our first quarter business. And right around May, it bottomed out again when rates went up, and our summer was a struggle, a huge struggle. And then I started noticing July up a little more, then August, then all of a sudden everyone's brain was tied to the Fed rate, which is correlated, but it's not really the mortgage rate. Everyone just started coming into model homes again, and we had really an excellent September. I think the next couple months will be good, and really just kind of excited for 2025 to see where that goes.
Matt, what about you? We have a lot of business owners in the room, and one strategy to grow can be acquisition. Is the rate environment attractive to those things? Where the higher rates detrimental? What do you see?
Yeah, I mean, it obviously has a pretty direct impact. And so most of the work that I do is in smaller to middle market opportunities. Again, it's all technology. And I think that consistency here is there's an emotionality that is tied towards interest rates, right? People are like, okay, down, let's go, up, let's stop. In deal making in mergers and acquisitions, last year was just terrible, right? I mean, it was awful. It was as down as it's been in probably 10 years. And this year is better. I think that people got used to the normal of what, in their modeling, what a higher interest rate environment would be. But it's not great. It's below the 10-year average. And so clearly, as interest rates goes down, private equity, financial investors are going to be less risk averse in their opportunities. There's going to be more money at play. That conversely has an effect on founder-led businesses, smaller businesses that know that there's more deal flow to be had, and so they then may be more encouraged about going to market as a seller. And so, unfortunately, the caveat to that for right now is there's other uncertainty in the market, the political uncertainty, right, and just general economic sort of flatness, if you will, in technology. Capital expenditures are down across the board. For technology, there was so much spent during the pandemic, and so I think that CFOs of large organizations have said, hey, we can take a pause, right? But all that to say that clearly interest rates are going to have, the declining of interest rates are going to have a positive effect on deal flow. Likely more is going to happen in 2025, similar to what Paul said.
Thanks, Matt. Kelly, I'd be curious to get your thoughts as someone who touches a lot of different types of companies, from HR, finance. You see a lot of different things. Is there any segments or industries that you're seeing perform better or worse than any others?
Absolutely, thank you. So a lot of the work I do doesn't fit necessarily in a spreadsheet, and it's just from talking with different organizations. So I echo a lot of what I heard here in terms of there is an emotionality, and I think with the higher interest rates, you do see more of a lag time, but what we are seeing is that the deals are going through, the investments are happening, there's just a lag time. So going back to what you said in terms of are there industries that are performing better than others, I'd put it in two buckets. So one, companies that are innovative and have fun stories. I think when you look at, I don't know whether it was COVID, whether it's the demographics of like the up and coming workforce, people want a good story to follow. And so I look at the companies that we support that are growing by leaps and bounds. And they across all industries, whether it's food manufacturing to healthcare, but companies that are looking at things in an innovative way, they're on fire. It is the enormous companies that have gotten too big where they can't move quickly that are struggling. And so, and the other piece I would say, private equity, we do so much work in the PE world, and there's a ton of transactions going on. And so that second bucket is actually really non-sexy businesses. And so I'm continually amazed at what companies exist and what they do. I mean, I was talking to someone that has an organization that makes the glue that goes between the layers in the lettuce bags, and they are on fire. Another person that does soap pumps, also on fire, right? And so things that you're like, that's a thing and you can make money doing that. So, but those companies go on to be acquired. So those mid-market tend to be great spaces for us. Did I get your whole question?
Yeah.
All right.
Yeah, nailed it. I want to kind of then move to Pete, because Pete, you have all different kinds of real estate in your portfolio, and whether it's retail or multifamily. Anything that you're seeing as far as your properties or projects you're looking at that you're kind of more excited about certain spaces than others?
I know this is going to be a contrarian view. Well, actually, I'll start with down the fairway. Industrial is clearly a darling and will continue to be that. And I think we're finding really interesting opportunities there as we think about kind of reimagining space. And I think one of the things that folks, you think about the tradition office and the access that you have to amenities just outside of the doors. I think what we're finding is that there is a significant value to the creation of place, the mixed use nature of anything. I mean, we look at our holdings at 50th and France, and the ability for different product types to cross-pollinate is really accretive to overall rents. And so where we are making bets in housing, we are also trying to really wrap that with other complementary uses that can ultimately drive both top-line rents, but a faster absorption rate. I think that, and this is where the contrarian bet comes in, I think that office is closest to an entire reset. And so we're starting to see office buildings that are being offered for sale in the suburbs, which come with quite a bit of land. I mean, you can imagine that 4 per 1,000 parking, you got a lot of outdoor space to work with. These office buildings are trading in some instances as like $20 a foot. We're involved with a building downtown. It appears that will be $9 a foot. I mean, at a certain point, these buildings have like the steel and the roof membrane has some value. And so I think what we're going to find is a really interesting opportunity to really look in the suburban office space, particularly 2-story office buildings, and start to think about tearing out floors and leaning into industrial. We've been exploring that on a project right now, and I think that's I think there's some really fascinating kind of risk adjustment that exists when you start to explore that. But, you know, down the fairway, industrial, housing obviously is great, but this goes back to the whole rate environment. And if you have to bet that you're either going to have a decline in your underlying interest rate and an increase in your top line in order to get to positive yields, that feels like you're maybe in a market too soon. And so we're going to watch and continue to be selective and kind of wrapping the existing assets that we have with other complementary uses.
Thanks, Pete. Paul, I'd be curious to get your thoughts. I mean, obviously we've seen decline in office values. Housing, we've not seen declines yet, and it seems like that's the one that's just continued to creep up and up. What do you see as far as, is that going to continue, or where do you see that going?
Honestly, the best part about high interest rates are it really kind of slowed everything down. When during low interest rates, it just took off like crazy, supply problems and labor problems, cycle times that add really the most to our cost, long cycle times. It's really brought it back. High interest rates have brought it back to balance, and it's brought costs back to balance. Therefore, we're pretty stable as far as where our retails are. So if there was one benefit, it was that. And right now, we're a part of a builders group of different builders around the nation, and everyone is honestly almost more scared to see a mortgage rate of 5 at this point because of what could potentially happen, take off too much, drive up costs. That honestly is the scarier part right now. So we're, as an industry, we're really in balance right now, and that's been a good thing because affordability is such a huge part with housing right now.
And maybe I'll go with Chad, if you want to start, and then maybe we can get Greg's thoughts just on the recent employment numbers have seemed to be relatively stronger than people thought. Anything that you see as far as you're watching on that side of things are concerning, or do you see more positive trends than anything?
Greg, you want me to start? Yeah. No, I would say that we work with a lot of business owners. I'd say the market's really good right now. People are looking to hire. They can't find qualified talent. We're starting to see the numbers tick up as a pure unemployment rate. We've seen some massive layoffs at even some big tech companies, Microsoft, close to us. Everybody's about corporate profitability, and as long as things are going to go good, they're going to need to get the workforce. I think this AI is going to play a significant part in this as we go forward. I was telling Mick earlier today we're going to rename our company TraditionWealthManagementAI.com and try to sell for a big number. But anyway, we watch these concerning factors as it gets to employment, because that makes everything go. Whether it's buying a car, it just can collapse industries when you get these higher rates. But as far as the pure employment, we get calls. Brad, we get calls every day that there's a lot of these college kids that, they don't have jobs. So I think it really matters on where you're looking for. And if you're at Microsoft and you lose a $380,000 job with stock options, those are tough to replace.
Greg, do you want to?
Yeah, kind of on that note. So there's a couple things that I look at in terms of employment numbers, and what's always been curious to me is the fact that the market really focuses on the non-farm payroll number and the unemployment rate kind of as the two big numbers. The problem is both of those are lagging indicators. They're backward looking. So it's kind of like, trying to drive your car down the road while looking through your rear view mirror. As long as the road stays straight and you know where you are and you know where you've been, but you can't see what's coming. And so that's one of the reasons that, in terms of looking forward, there are a host of other statistics and economic numbers that I look at that you don't really see mentioned on the, you don't see the CNBC or whoever on the Squawk Box talking about this stuff. But they're really the forward-looking numbers. The JOLTS job openings year over year. There's an employment trends index that nobody ever talks about. That's a composite of all the kind of forward-looking numbers. Those and there's a couple other ones. There's a small business survey, and those things all kind of topped out in mid to late 2022, and they've all been declining ever since. And so the recent kind of more recent rise in unemployment, is not surprising. It's if you were looking at those numbers, you could see it coming, a year and a half ago. The non-farm payroll number, I'll just say a couple of things, is that, those numbers have been solid, and they've been solid for, the last couple of years. But if you kind of peel it back a little bit and say, okay, there's a 250,000 jobs created this last month, big number, larger than the market was expecting, so it's off to the races. But looking at that number, 176,000 of those 250,000 jobs that were created were in low-paying service jobs, and which is 70% of that total. Another 12% was from government. And if you look back really kind of after COVID and all the way up to today, that's been pretty consistent where, 80-85% of the jobs being created are low-paying service jobs and or government. I mean, government's been, 25-30% of the payroll number every year for the last, or every month for the last, year or two. So, in terms of, does that cause concern? I don't know. I mean, I think that, those low-paying service jobs, they're not going to put food on the table for a family. And the government jobs, great, government's been expanding for the last couple of years. But those things, I think, are, more structural in nature. So that causes me a little concern. I don't know what the impact of that all is, but if, almost all the jobs created in the economy, month after month after month are either low paying or they're government jobs, that, doesn't exactly point to a robust economy. But on the other hand, unemployment's low. It's going higher if you look at the leading indicators. But, at the same token, it's still a lot lower than it has been in the past. So,
well, Kelly, I'll keep it right here with you. Would you say, what are you seeing with your clients on the hiring side? Are they looking for talent, or kind of what's their situation?
So a couple things when you talk about whether you're predictive or looking in the rearview mirror. So our recruiters are a predictive indicator, and in January we had a lot of recruiters sitting on the bench. I can tell you now, if you want a recruiter, there's a line for them. So that's a good thing, right? That means companies are hiring. I also, when I look at some of the people that are, while it's unfortunate, the unemployment side, and I actually worked at Microsoft before launching Berlect, I think some of those companies got fat for a while, right? They had a lot of roles that weren't needed there, and so, and it is unfortunate for those people, but I do think it's just kind of a right sizing. I'm not concerned. I think we're seeing a ton of hiring. And the other thing we're seeing is employers are looking to hire differently. So they are looking to be nimble, to be more flexible. And so they're using a lot more consultants. 10 years ago, if you were doing maybe an acquisition or an ERP implementation, something that you knew would create this peak, you would hire long-term employees for it. That isn't happening anymore. Now employers are realizing, gosh, we can bring in a team of consultants to do this. So how that FTE and unemployment, it just looks different. The last thing I will say too, when you look at the demographics and the number of people that will be stepping out of the workforce that are retiring, it is a huge, huge number. And so we've been putting a lot of focus into how do you redeploy those people in a way that meets them where they want to be, because they have a lot of value. and companies need them. I mean, there aren't, when you look at the people that are coming into the workforce, there is not enough people to replace those people. So I actually think we're in a good spot for people who continually reinvent themselves as employees. We're in a good spot, and for those that were impacted by things like Microsoft, which is again difficult, but it's time to figure out, like, how do you do things differently. So
Matt, I feel like your former line mate did set you up here today by bringing up AI, earlier. So I want to just get your thoughts on the employment side. Are you seeing companies utilize AI, like Kelly said, trying to be more efficient and hiring smarter? And is that a tool that you see as being something that can help on the employment side?
There's the positive and the negative, right? And important to note that AI is the new marketing buzz. In general, what it means is automation, right? The automating of businesses, and the automating of businesses allows businesses to be more competitive and more effective, and then they grow, and then they want to hire people. The flip side to that is automation can also take out employment, right? And the context to generative AI, which is the next generation of AI, has the potential to take greater numbers of people out of the workforce. Now, typically those are going to be lower skilled workers, so that what is going to be needed to be effective is higher skilled data-based resources, information-based resources. Now, we're really, really at the very beginning of this, and so the impact of real generative AI is not going to be seen in the next 12 months, in the next 18 months, in the next 24 months from a macro level of employment. Ongoing, I think that people need to see the trends of how the implementation of real generative AI is going to impact the lower non-skilled workforce.
That's very insightful. Thank you, Matt. Kelly hit on something I want to focus on a little bit, which was the big demographic changes. We obviously have we have an aging population. We have a transition of the workforce, so it can impact a lot of different things. And maybe Paul, I'll start with you on that and just see what you're seeing in your business, as far as I don't know if kind of the aging demographics, you're seeing people downsizing, if you're seeing younger people having different tastes or buying ideas on the housing side. Maybe comment on that for us.
Yeah, it's definitely something that we're counting on, is the downsizing. We know there's a need for it. We've designed product that is definitely smaller, a little more affordable. Some of the other products that we've put out have been, I'd just say, a little bit out of reach for most. I'm trying to look at the buyer pyramid and getting lower down. And what's interesting on the younger people, we've had any range where they'll be in stuff that's a little lower price, but then you'll have a 20-year-old single woman that purchased a $900,000 home, and it's just interesting to see what different things they're wanting, and even small families just buying a bigger home right away.
And Pete, would you say, are you seeing the changes on your side and the commercial side? Does it mean more renters? Does it mean less rent? Or what do you see on that side of things?
I think I'd say two things to that. Our 50th in France, larger unit-sized apartments, which we've offered anywhere from 1-year leases to 5-year leases. You're seeing a lot of folks move into that space. And we were, I think, an earlier mover in that. But that's proven out in the performance since it delivered in 2020. I think from a fund business perspective, the demographic shift has been even more notable and more surprising. And that is, if we look across our investment vehicles, oftentimes we've been viewing this in the lens of the Carvel days of let's go, knock the cover off the ball and try and deliver, teens to, whatever you can ultimately get in excess of that. our high net worth investors have actually shifted to say, no, we don't want that. We want a more we don't want a zero coupon bond. We want something consistent. And so with the backdrop of having fixed rate debt, we've been exploring bringing our portfolio out as a private REIT because the demographic shift actually aligns more closely to where folks want to be seeing yield. So it's I guess, two ways that we're observing that change, and it's been pretty significant.
Matt and Kelly, I'd love to get both of your thoughts. More on as we see more business owners aging, what are you kind of seeing there? I don't know if Matt, that's part of what's driving some M&A activity. Kelly, I'd be curious to get both of your thoughts. Matt, why don't you start, and then Kelly.
Yeah,
can
sure.
go.
So, one of the real positives, and again, working in the middle market, there is just a time in which business owners say it's time, right? And that's been positive, that's been consistent. I think that there's another group where it's not quite time. However, they recognize that they've got a very stable and solid business. And at the same time, financial investors have started to go basically down market and looking at smaller opportunities than traditionally they would have. And so there's interestingly, for a middle market business, an opportunity to de-risk, if you will, by joining with a financial investor and then having call it a fourth quarter run with a new partner that is able to infuse capital and have a great last chapter of a career. So we see both of those scenarios happening where there are some where it is just time, baby boomers, if you will. They've successfully run a very stable business for 20, 25 years, and then now it's time to monetize their life's work. At the same time, we see these opportunities for those that are maybe a period before that, and again, combining that with financial investment in a little bit lower market.
So I actually just moderated an event recently for people who are getting ready to sell their businesses. And so I think, yes, there is definitely a part of that where there are a lot of people that have built successful businesses and are looking to go on, whether to retire or do the next thing. And there are, I've learned through that a ton of complexities, people that are, establishing residence in new states to minimize taxes. But yes, there is that. The other thing that's interesting when you look at the demographic that's exiting, we call it nouveau retirement. It's different. And so I think what that impact is in terms of spend, in terms of how conservative people are with their money. I just hired someone who is in his 70s. He has started and sold 2 very successful companies. He does not need to work, and he just finished his MBA, and he's bored. And so, for these types of people, they will continue to, be working in the workforce. They just want to work differently. So I know that's a little different than the topic, but it does impact, right, the dollars that come in and people's investment strategies as well. They're not looking to be as conservative. So it's just a different market. And then you also have people that maybe sell their business when they're 40, take a couple of years off, and then come back. So it's a different way than I think when, maybe the generation before was stepping out of the workforce.
Well, thank you. We're going to wrap just my questions, and then I'll turn it over to the audience here for questions. But maybe to finish, we'll just go with a little lightning round. Not really lightning round, just it sounds cool. But I'll just have everyone chime in on the biggest opportunity you see out there for your business.
For us, I think it's twofold. One is culture. So, again, not something that can be put in a spreadsheet, but when you think about competing for the best talent in the market, because if you're going to deliver a good product, you better have good people to do it. And culture is everything. So how do you maintain that as you grow very rapidly? We are looking at geographic expansion. And so how do you do that in a way that keeps that culture so you can really keep the best people and also that attracts clients? So So that is for, I would say, kind of the biggest thing that we are looking at. I'm trying to think. Those are, honestly, that's the biggest thing as we look at expansion.
I'll defer to Chad for the most part on this, but I think one thing that, you know, our business since I joined 7 years ago, it's, you know, we have multiple times the amount of assets under management than we had when I joined. And one of the things that we've done over the last, you know, year or two in particular, you know, the more clients and the more assets you have, you can continue to provide service and continue to, you know, increase your value proposition if you're efficient. And so we've invested in some systems over the last year or two that are, you know, big investments for the firm, but we're just starting to kind of recognize the fruits of some of that. And I think that, you know, it's just going to help take something that's been historically not that efficient, and our business is not terribly efficient, and this is something that gives us more information and more control and more ability to scale our business and provide everybody with the type of service that they need. So that's what I'm thinking.
I think the opportunity for us in this next cycle is really just larger and non-strategic institutions exiting. And so that will reset the cap stack, and that'll provide a really interesting entry point that I think, looking back 5 years, we're gonna wish that we had backed up the truck more.
You know, in the M&A market, I think that there's a lot of pent-up demand. I think that, you know, the factors that we've talked about, higher interest rates, you know, economic wobbling, a little bit of uncertainty is just decreased deal flow. And when there's decreased deal flow, there's just, that's gonna change. There is demand, there's money that has been sitting on the sidelines. In my space in particular, obviously technology investments are going to continue, AI and the like, for founder-led businesses who are running good, stable, solid businesses. There's a lot of pent-up demand for those opportunities. And so, you know, again, I don't think that's going to happen in the next 6 months, but I think that overall deal flow is going to increase substantially as we move into 25 and beyond.
And for us, I think the biggest opportunity is kind of back to the demographic, the empty nester market, and first-time home buyer, smaller product. Was at a seminar about a year ago where the keynote just almost scolded all the builders in the room. He says, "You guys are all building the same house, 4 bedrooms, 5 bedrooms for the smallest part of the market. You know, go build where there's a bigger market, and that's in 2, 3-bedroom houses." So that's kind of going to be one of our focuses.
I just celebrated my 30th year in the business, and you all of a sudden wake up and you're an old fossil that everybody looks at. The biggest thing in our business is people are looking for people they can trust. The holistic planning, our ultra high net worth clients that are dealing with the death tax that's coming. You start hearing about 45% capital gain rates. The floodgates are open. So, I mean, the opportunities that we see are just everywhere. But I would say that's the thing. You know, we do a multi-generational, so if we bring in a new client, we're helping the kids who need help. They're super efficient. They know our tools that we use, and it's just a great way for us to leverage what we think the future is going to be.
All right. Well, enough from me. Let's turn it over to the audience, and I think we have some mics. Otherwise, I can walk around. Does anyone have any questions for the panelists? Anyone on the panel? We're happy to open it up and see if there is. Oh. Ryan, you have one? Mike's coming.
I've got one over here.
You got one over there? Okay, here we go. Right over here.
Yeah, I'm curious on the panel, what is your favorite investment opportunity that you're seeing right now? Real quick, go.
Well, with the help of Tradition Bank, I've become a commercial real estate investor in the industrial space. And so I would say, and I'm very happy to hear my fellow panelist over here. So I personally do, and I looked at that and have looked at it for a while, and I think that that is going to be an interesting space for a while to come.
I think from our standpoint, we have two deals that are that we're underwriting right now. One is a long-term leased office building that will yield right out of the gates unlevered 16%, and we think there's a framework for reasons that that particular tenant wants to stay. So we're looking at that. We haven't put it under contract yet. And the second is an example of an institution exiting the market, and it's a vacant building with some functionally obsolete industrial space, whereby we take that out and we can fairly quickly backfill. But the entry point from a pricing standpoint represents, call it 70% of replacement cost, and so that sets up pretty well.
Jed, you want to go, and then we'll turn back.
Good question. There's currently 60 major stock indexes. There's 43,000 publicly traded companies, and the bond market is about $133 trillion. So, we kind of look at it more, not as granularly, but I would say if I saw the slides up here that were saying, hey, everybody's down on international or global economies. Global economies, their stocks are making more highs than the S&P 500 right now. So some of these markets are at a substantial diversion right now. Like if you overlay the S&P 500 to emerging markets, it's trading at a 41% discount to its historic norm. And you're seeing that as well in some small caps and things. So I hope that answered your question.
Question for Matt. With the AI that you said maybe let's say 2 years in the future, do you think that could speed up so fast where it hurts the unemployment enough to affect the economy? Like if it speeds up so fast before people can get trained in to take those steps?
Take what I say with a grain of salt, because if I add the crystal ball to that, I probably wouldn't be sitting here. I don't think so. There's some underlying challenges that all organizations have to be able to truly take advantage of the most advanced generative AI. There's challenges with their data. There's challenges with their existing business models. The biggest challenge is the challenge of change. People and organizations simply do not change that fast. And so I think it will be a slower rise. I do think that organizations will need to plan and have models for themselves that go out further. But no, do I think that it is there's this dark cloud that we should be thinking about because of AI? I do not.
Chad kind of answered my original question. Oh, go.
Sorry. I was just going to add, I spend a ton of time going to different AI events, and I would echo that. I do not think it is going to be something catastrophic for unemployment. I think it's just a shift in the market. So the amount of work that has to go around security for companies to use AI, the amount of training that has to go into their people, it's just a shift in the skill set. So, and quite frankly, AI is not new. It is getting used more and more, but I think ultimately it should be a good thing in creating jobs that are more interesting for people. So I think it's an opportunity.
Go ahead, Mick. All right. Chad, you kind of answered my original question, but so I'll turn another question to Paul. So I've got a stepson in the room here, and I've got children that are kind of in their early 30s, so that first-time home buyer. With rates declining, where do you see home prices going in the near future, and what would your recommendation be to that group of people in regards to timing to getting into the market?
I would say really now is the time to buy, because how rapid things went up when, again, the there was no supply and the demand. Right now, it's like I say, we're in balance. Our costs are in balance. It honestly just feels really good. And if we do get a big run, I think it's going to shoot up pretty quickly, especially with the product. You know, another interesting thing is just having really no existing market right now. It's really pushed an advantage to builders, and the cost between existing and new are extremely close, where that's never been the case. And the other advantage, as far as from builder standpoint goes, we've had to utilize incentives and buy down rates, and right now a lot of builders are buying rates down, so it's a great opportunity right now, I would say, to buy a home and obviously have the chance to refi into a better rate someday. Raw materials have been honestly really fairly stable. Concrete always seems to be creeping up, but lumber was the big one that everyone remembers, where it just ran and ran and ran, and you couldn't catch up with it. And it was really a good day to see it level back off. Labor is always going to go up a little bit too, but right now, for the most part, materials are pretty sticky. It's been good.
Our first panel-to-panel question. That was great, Pete. Thank you. Yeah, that's a new one. Great. Thanks, Paul. And if they need to get pre-qualified, Eric Hendrickson's in the back, too. It's a great time to buy a home. You heard it, right? All right, question right over here.
Yeah, this one is for Pete. You talked about converting office space into industrial space, taking the ceiling and floors out. What challenges do you see in the government restrictions as far as zoning is concerned? Do you see, converting that office space into industrial as far as government restrictions?
There's absolutely a hurdle to get through there. But I also think there's a sense from various municipalities that we can't lose tax base. I think you're seeing it downtown in Minneapolis, right? That you can't have these vacant buildings get reassessed at, Xcel Energy's office building sold for $564 a foot. Well, again, if a vacant building is going to trade for $9, the assessing authorities are compelled to reassess at whatever that number is. And so the question would be, as I kind of think of this in more of a complex form, what does that then mean for some of the taxes? What does that mean for mill rates, and what does that mean for consumer spending? Because that relates to some of our retail investment, right? And just free cash flow to be able to go out and buy goods and services. So short answer is yes, we're going to have to get through that. I think we've seen municipalities jump to just say, if you can go fill this with jobs that are going to support the retail down the road, go have at it. We'll roll out the carpet for you.
All right. We got one in the back.
So this one's for Kelly. Kelly, it seems the gig economy is here to stay, and you kind of mentioned how those exiting the workforce likely will become part of that gig economy. But I sense a lot of hesitancy among small businesses and kind of lower middle market companies to sort of buy into that concept and maybe try it for the first time. What do you say to that?
Good question. Thank you. It's interesting so a couple of things. Yes, you're right. For people that have not used that model before, there is a hesitancy. And so I think, one, it's an education process. So for, small companies that have never used that model, we need to walk through them. And I think a lot of times what they do is they take the salary that they would expect. So if you're like, okay, this person's, $100,000 a year, they divide that by the number of hours, and that's what they expect to pay. And so you have to educate them about, well, no, what does healthcare cost you? What do payroll taxes cost you? What happens if you need to let this person go? What does that unemployment look like? And so educating them on that, and then also educating them on, it's not just the cost piece. Can you get something done faster and then move your money to the next thing, right? And so if you hire someone, for example, when we have, new clients that are new to this and maybe something is a huge mess for them and they need someone who can come in and clean it up and they're a heavy hitter, that person can be in and out in a short period of time and they only pay for that finite period of time, versus if they were to hire a full-time employee to do it, one, they're either going to have to hire much higher than what they need, and so they're paying much more than they need long term, and then that person's going to be bored out of their mind once they're done, or they'll hire at the level that it will take them 3 years to clean it up, or they will never clean it up. So it's an education process, and I think as we're seeing it really pick up speed, like the private equity groups love this model. We just did a PE roadshow and it's been very successful, and the big companies, the Medtronics of the world, the UHGs of the world love this model. It keeps them nimble, and really reduces the amount of layoffs that they need to do when things change. So, but yes, it is the gig economy is growing like crazy, and it's both the supply and the demand.
All right. We have any others? Otherwise, can I get a round of applause for our panelists? I want to thank them as well, and thank everyone for coming. We have the room a little bit longer, and I would encourage everyone to stay around. I think one of the great things about the event is not just the information, but just the connections you can make, and that's what I think is kind of even just more important. So thank you everyone for coming, and bar's open, and we'll enjoy your time. Thank you.